Today I'm going to devote my lecture to what I call quantitative methods. Now, I'm not going to teach you things that I know you already know. Instead, what I'm going to do, I know that you come from a quantitative background, okay? And instead, what I'm going to do is I want to try to put it into an investment context, everything that you already know. I will develop some notions and some even methodologies, but I'm going to assume that all the technical aspects you already know. I'm going to assume that you may not be familiar with how these things actually find their way in the world of real investments. So that's what I mean by quantitative methods. And I'm going to start with a reflection. I want to tell you my perspective of what the last 100 years of investments or quantitative methods have been. I want to start with exactly 100 years ago. Something very important happened 100 years ago, and that was perhaps for the first time in history, accounting was regulated. Companies had to produce accounting statements, had to produce information to shareholders that had to be correct. This was a consequence of the big regulatory wave that happened in 1933. And the big regulatory wave that happened in 1933 was as a reaction to the market crash of 1929. Do you know about 1929? The crash of 1929? Okay, so I don't know. Good. So that was a crash that was created by a number of deficiencies, some of which were regulatory. For example, insider trading was legal, which prompted people to benefit from the demise of their own institutions. The CEO of the Manhattan Bank made about $4 million of the time shorting his own bank, because he knew that this was going to be ugly. Market manipulation was legal, and it was commonplace. So as a result of everything that happened there, a regulatory framework was developed in 1933 and 1934 that regulated how companies work. So what's interesting is that in the 30s, companies had to report information that was correct. Up until then, you could report information that was incorrect. I'm exaggerating just a little bit, but what I'm saying is that you could work with information that was trusted. That gave rise to what we call today value investing. Value investing is investing on companies using information which comes from their financial statements. And that was introduced 100 years ago. Why? Because people could do that. So the quantitative methods of 100 years ago were methods that you could develop with a piece of paper and a pencil. That's all people had. In 1950, something happened. We're going to see what happened today. We're going to get into some detail about that, but you probably already know about Harry Markowitz and his Markowitz theory. That was the beginning of what's called modern portfolio theory. I assume you know that. I will review it today anyway, because I need you to know it my way, a little bit different. But it's important to reflect on the fact that this would have been impossible if it had not been because computers were introduced at the same time. The use of time series in finance is linked more to the fact that computers were developed in 1950 than to the fact that Harry Markowitz did his thesis in 1950. Do you understand what I'm saying? I'm trying to draw a technology parallelism between the developments that we have seen in finance and the developments we have seen in technology, because they've always been hand in hand. And then what happened in the 90s is that everybody had their own PC. The arrival of the PC signified that everybody had access to a computer, and therefore everybody could implement their own numerical method. And this had the consequence that you didn't have to be Harry Markowitz to come up with your own portfolio theory. You could develop your own, and people did. And the result is very interesting because people, this series wants to take part, has a question, so I don't know how to turn it off except just put it in my pocket maybe. No problem. Maybe if I put it in don't disturb, I don't know. Maybe. Okay. Sorry, I lost my train of thought. Yes, I was about to say something very important. Everybody developed their own portfolio optimization machine. And as you can imagine, 90 or 95% of them were just nonsense. But we are very tempted to believe everything that comes out of Excel. I say that Excel is responsible for trillions of dollars of lost investment money, because it's very easy to believe what comes out of Excel. Excel does not make mistakes, we know that. The one who makes the mistakes is the human that operates the Excel. And if I present the results to you in a beautiful chart with the right colors, then everybody will be drawn into making that decision. Well, all that happened because the PC was around. Now, the big change happened for us in the year 2020. And this is what I want to talk about. In the year 2020, the arrival of AI started to change how we look at numerical methods. On the one hand, we have access to news. There's websites for everything. But for me, the ability that we have to process documents in real time is having a tremendous impact on everything. I mentioned yesterday, and I repeat today, and I'll probably repeat every day, modern finance distinguishes from older finance in its ability to consume data which is not only numerical. The ability to consume data which is textual is important. I mentioned yesterday GameStop. We talked about that a little bit, and I announced I was going to talk about that later, and that's today. GameStop is a very good example for me of how finance is different now than it used to be, say, 10 years ago. Because if you want to understand what GameStop was, you need to have access to Reddit. If you read what Bloomberg is reporting on Bloomberg data feeds, it's too late. The interesting story happened maybe 8 or 24 hours before you see the numbers on the Bloomberg terminal. Right? In fact, a lot of this, the big development for GameStop happened on a Monday. And why was that? Because during the weekend, Wall Street Bets was very active, with people sharing stories about a gamma squeeze and options being due and all of that. So it was the news story that developed that. And that's the important data that we need to understand finance today. Now, it's not the only one, there is more. You may have seen this acronym ESG. You've seen ESG? ESG. We're going to see a little bit about that on Saturday. That's my last lecture, because on Saturday I want to talk about science fiction. That's how I will end my course. I will talk about the stuff that no one knows, not even I know. But I have a certain sense of smell as to what's coming. And I'll be telling you that. And ESG is a very good example of that. Now, ESG is very old, don't get me wrong. I'm not saying that the future is on ESG. ESG is part of the past. Actually, it's perhaps part of the present, because that's a but there's some futuristic aspects to that, which I'll tell you on Saturday. Today, I want to mention ESG in the following sense. I want to tell you why ESG and GameStop is the same thing. GameStop was a social wave created by several million teenagers on Wall Street bets. Agree? ESG was a social trend created by several thousand investment companies selling products to several million baby boomers. Do you agree? Okay, what is ESG? ESG stands for environment, social, governance. This was 20 years ago when it was introduced for the first time. It was the implementation of a statement, of an objective, a stated objective of many big asset managers, that they wanted to favor certain types of investments that had no negative impact on the environment, on society, and was done according to proper governance structure, ESG. And it was there for a long time until in 2018, it became a sales mechanism to sell funds. We already learned yesterday that the key to investing is selling. Managing your investments is number two, because most companies make money on the management fee and not so much on the performance fee. So ESG became a very convenient label for many commercial funds to sell products when markets were not particularly good for the mutual fund industry. Okay. Today, the amount of funds which have the label ESG is in the trillions. It's a very big sector. It's going to grow more. I don't know if you are trying to, I don't know what message I'm giving you about the future of ESG, whether it's going to grow or not. I will tell you about that on Saturday. You will see that it's going to grow, but in a different form. Okay, so I don't want to settle that dispute now, and I said I don't want to have a controversial discussion on ESG now, but I want to tell you that GameStop and ESG are very similar from that perspective. They obey to a new type of investment objectives that we have never had in the past. These are investments which are not necessarily made to make money, they're made for other reasons. So the world of investing is becoming more complex. And the thing is that AI allows us to bring that complexity into our decision making. So here's 100 years of evolution from a situation where we had access to very little information. You had to make an investment decision based on what, 3 numbers maybe? To a situation now where you have 1 billion of data points that you can analyze in real time, and you make your decisions on that basis. And everything that we have quantitatively is somewhere in the middle. So today I'm going to walk through all of this. I will start actually here and I will end all the way to today. So it's 100-year voyage that we're doing today, focusing on quantitative methods only. And again, I know that you know all the math that I will need for that. So allow me to just do that journey for you, making reference to things that you may already know. But again, put them in a context which is very, very practical. All right, so I want to start with the first thing. By the way, I know I will be controversial in some of the things, and that's good, because I like controversies, especially in the classroom, because it allows people to think critically. So portfolio return, you probably know that. If I give you, and this goes back to Markowitz, to the time series basis to doing portfolio analysis, if I give you the value of a share, the share could be a company share or a fund share. Funds are sold with shares. We saw that yesterday, right? So a share of anything. If I give you the value of your shares over time, daily, monthly, typically, then you can calculate the return by that formula. You've seen it many times. You take the value today minus the value yesterday divided by the value yesterday. Right? Great. Now you may also have seen the logarithmic return, which is done by taking the logarithm of the value today minus the divided by the value yesterday. You may have seen that also. Yes, right? Yes. You've seen both? When do you use one, when do you use the other? Do you know? That is an unfair question, because we don't even know why we would use one or the other. So let me spend some time telling you about both and why we would use either of them. Okay, the answer is actually quite tricky. So what we agree is that we are going to be collecting information on a daily or monthly basis, and then this time series of returns probably is going to have some meaning, but there's a chance it has no meaning. So let's get into that a little bit. And what you will also agree with me is that once you have that time series, with the time series you can create certain mathematical objects. These are objects created by humans. They do not exist in the market. Okay. The first one is what we call the portfolio cumulative distribution function. Defined there is given a number x on the x-axis gives me the probability that my return is greater than or equal to that number, that benchmark. Yes? That's the cumulative distribution function. It's a distribution that probabilists use for everything they do. Every time you have a random variable, then that is your cumulative distribution function. And there's a close relative to it, which is the portfolio density. The portfolio density is a close relative of it because it's given by the derivative of the cumulative distribution function, and it's this yellow curve there. And let me say that people in management, they like to use the yellow curve, and people who are more mathematical like to use the green curve. You agree with that? Your choice of color? They're both the same, really, right? Just that Excel gives you the one in yellow, does not give you the one in green. So that's why many people use the one in yellow. But I think you are both, you can deal with either, right? Both of them are just as good for you. You don't care which one you use. Okay, great, perfect. All right. So you may have seen this expression too, the one that says that if I give you some return on a, say, monthly basis, I'll typically say monthly basis, then I can have the average return to be the sum of all the individual returns divided by the number of observations. Do you agree with that? Okay, let me spend some time on that. Some people believe this is the definition of return, or the definition of average return, or the definition of mean return. But this is not a definition, is it? This is my return every month. This is the number of months that I have, and then I take the sum of that, and then that gives me the return. But that's not the definition. Equally, I could have the standard deviation or the volatility, and it's given by a formula which is there, and you have seen this expression too. This is the one that Excel uses, right? And you probably know that they have the n minus 1 there as opposed to the n because this is the population, and you may have seen that, right? And you may even know the difference between divided by n or divided by n minus 1. That's not very important right now. What I want to tell you is that the definition of either of these is actually not that. The definition is something different. The definition requires that you know the entire density of your distribution, not just the observations. So I will say that the definition is what's on the yellow box. Sorry, on the no, there's no yellow box. On the blue box, and we have in the center is actually the estimator. One is the estimator for the other. Or if you like philosophy, I would say that this is a Platonic description of the world. The world of ideas in Platonic philosophy would be in the blue box. These are the things that exist in heaven, but we don't get to see them on earth. On earth, we only see the shadows of that, which is what we have in the center of the slide, which is what we call the statistics or the estimators. So allow me to say that one is in heaven, one is in earth, right? And on heaven is where mathematicians live, and they do their nice theories, which work assuming they have perfect information. And on earth is where we live. And when you're confronted with real problems, then you have to do things on planet Earth and not in the world of ideas. And things are dirty and inaccurate, but it's the best you can do. And your hope is that things are on earth as they are in heaven. Right? You know what I'm talking about? Great. So not only you have Platonic philosophy, we have also Christianity into the picture. So we're going to try to remember that rule for today. Okay? On earth as it is in heaven. Because it's a very good description of what we would like to have. If we are lucky, we will have both. We will have our earthly objects that would look like our heavenly objects. If we are lucky. But sometimes we will not be so lucky. And I have an example here for you to show you how disruptive this simple calculation is. And this is a source of a lot of pain and misunderstanding in the investment world, and it's very simple. I'm going to give you a fund that I created myself, and I started to trade it last year. And on the first month, I started with $1, and I made $1 that month, and I ended up with $2 for the next month. But then the next month, I lost my $1, which I won again the month after. And then I lost it, and then I make it. You understand, right? Great. So when I do this, what is the return of my investment? It's 25% per month. Anybody has any doubt about that? $25 per month. Well, that's if I use the simple return. If I use the logarithmic return, the average return would be 0. Anybody has any doubt about that? Okay, close your eyes. Imagine I sell you an investment that I'm telling you has a 25% per month average return. Would you invest in it?
Yes.
You would? Exactly. Good. So there you go. By the way, this happens, okay? I have my favorite example comes in about a couple hours. I'll show you an investment that was, someone tried to sell me. You see, it was very similar to this, you will see. And this is real. So I guess if I disclose the actual numbers, it doesn't look very appealing anymore. What's going on here? Can you tell me what's going on? The people who know math here, what's going on? The key is in the volatility. The key is in the volatility. This is a fund that has a lot of volatility, right? And you probably know that that 25% that you have there must equal, you know Ito's formula? Have you said Ito's lemma? What does Ito's lemma tell me? Ito's lemma tells me that the mean return of my simple return should be the volatility squared divided by 2 of the logarithmic return. You've seen Ito's lemma? Yes? Who has never seen Ito's lemma? Never seen Ito's lemma. Okay. Okay. Who has seen Ito's lemma? Okay. So you guys do not know what I'm talking about. That's okay. Don't worry. It's okay. It's not a requirement. Okay. You can have a wonderful life and not know Ito's lemma. But for those of you who know Ito's lemma, you know where this is coming from, right? You've seen Ito's lemma. This is exactly what Ito's lemma is, right? So for those of you who have never seen Ito's lemma, let me show it to you. There's a big difference between the logarithmic return and the simple return. I just gave them to you at the beginning as if they were just two choices that you have, and you can pick whichever one you want. In practice, they can be very different. And the impact is that when you have a fund with a lot of volatility, the simple return will give you a mean which is much, much bigger than the logarithmic return. Since most people quote their mean return in their marketing material, this works in the favor of funds which are very volatile. But now that does not mean that mean return translates into making money, which is a very common misconception. Okay, I like to say that statistics and accounting do not get along. Many things which are statistical, oh, there's no mistake here, by the way. I did not make a mistake. This is statistically correct. Okay? Statistically correct. Statistics and accounting don't go together. And to use statistics to understand if you're going to make money is a very typical mistake, such as here. Now, those of you who know Ito's lemma, it'll be harder to fool you because you know what that effect is. And if I tell you that I have a fund that has an average return of 25% per month, and you know Ito's lemma, your next question should be, and what's the volatility? And I say it's 70% per month. And then you go, 70% squared is 49%, divided by 2 is 25. No, so you're not making any money, are you? I said, no, I'm not making any money. Right? So we use things such as Ito's lemma to understand the relationship between different ways of calculating return. Because if I am a marketing person, where's my marketing? You're my marketing person. No? No? Sorry, same thing. Sorry. My apologies. Okay? If you're my sales guy, okay, then which number would you rather report to your investors? The average return. And if someone would give you one which is even better, you would probably take it. Right? In fact, you would probably be bothering the analytics department of our firm to change the way they calculate things so you have a better story possible to tell to your investors, right? You would probably do that. So we have to be a little bit cynic, but that's how the world is. Okay? So we better understand what returns are made of. We better understand what numbers are made of. And by the way, I'm taking here the simplest of all the numbers we could have, which is the simple return. And there already we see not just possible misunderstandings, but also ways in which this information can be used in a misleading way. So the next thing is I want to show you how we can use this. And what I have here for you, it doesn't matter where I got this data from, that's not important right now. But I have here the return of a number of investments, the average return of a number of investments over time. And what I did is, again, it doesn't matter how exactly I did it or what exactly is here, but if I take it a certain day and I look at the history of, say, the last 2 years, I calculate the average return on that day, and I let my window move over time. And that's what I end up with. Some investment. And what I see is that that number goes down, goes up, goes down, goes up. Seems to be all over the place. And what is going on with that? Why is that happening? Well, if this is a 2-year window, it gives me a number. If I move that distribution over time, I want to take a 2-year window, I want to have different answers as I run my distribution through time. So one possible consequence of this is to say that these numbers are meaningless because they change all the time. Typically, the mean return is used as if it has some meaning, meaning it's going to be persistent in some way, but we can see that it is not. It actually moves from one value to the next. And the reason that may be causing this is that the underlying time series we're dealing with, or the underlying distribution, is not stationary, and in fact is perhaps just a random sequence of numbers. So the average return, however you define it, is probably quite meaningless in itself. And this is the reason that there's a lot of skepticism in terms of using average returns. And there'll be more about that tomorrow. Now, if I do this for the volatility, I have this expression here. Let's look at the big curve. Let's try to understand what these things are. Have you read the book The Little Prince, Saint-Exupéry? Yes, yes. That is from the book, right? Is that a hat or the snake that ate the elephant? Remember? It's just like that. But no, it's the curve of the volatility of certain investments. And what is that volatility? It looks like we have the same phenomenon as before. They say lack of persistence. And in fact, what we have here is that the beginning of that hat, of that big mountain there, is when the financial crisis started. And the end of it is exactly 2 years after the financial crisis. And why 2 years? Because I'm taking a 2-year window. So this is an example of how my choice of 2 years for the window finds itself in a chart that seems to indicate that this investment had a high volatility period that lasted exactly 2 years. And in fact, the 2-year was my choice. So here again, we're looking at a sequence of numbers that has no real meaning. The meaning is the one I created by my choices. So human choices are always there. And it is a very big source of contamination of the data which is produced. One of the things that we can do today with good AI or machine learning models is that we can eliminate that. Eliminating the human from the decision making is good because it will help us get rid of these things. However, as you can know, it also makes us more powerful in the generation of misleading data. And the big dichotomy we have today is that it's very hard, very, very hard to tell what methods work and which methods do not work. And I wish I could tell you that AI today will make you more powerful. It's not true. It can make you more powerful, or it can make you more powerless, because it makes methods very difficult to evaluate and understand. Here we have some understanding because everything is very simple. And even within its simplicity, we end up with lots of different possible conclusions, and some of them are wrong. And when you use AI, you're going to have the same thing. The silver lining to what I'm telling you is the best use that your math knowledge has in this context is that mathematics is the best nonsense detector there is. There's nonsense everywhere. You're surrounded by nonsense. And it's very hard to detect when you put it into a big machine. So the objective today, for me, is to show you how powerful you are as a nonsense detector. That's it. I'm sorry if some of you thought that with AI you can decide what to buy, what to sell, and this and that. No, not really. Okay. In fact, usually AI does the opposite. It misleads you into believing this or believing that. So we're going to be very cynical today. We're going to be very, very cynical. I'm going to review a lot of methodologies, and we're always going to look for the same thing. When does it work and when it doesn't work? And when it doesn't work, how can we fix it? But I can tell you, 90% of the methodologies that exist do not work. They look like they work, but they don't. And this is why I believe Excel has been responsible for trillions of losses in investment decisions over time. It's very hard to go against Excel, very hard. And it's very easy to come up with an Excel justification of whatever it is that you want to do. Okay? So let me continue with that. I have here another graph, which is, I've done the following. In all of the disordered system that I showed you earlier, with the mean return that goes nowhere and the volatility that goes nowhere, in fact, it misleads us into thinking that we're in a 2-year period of high volatility, when in fact it was just a numerical artifact. When I do the scattergram of that disordered system, I come up with this. And here suddenly we have meaning, because I can identify I only took 3 of my investment instruments, one which is clearly high risk, one which is clearly medium risk, and one which is clearly low risk. This is something which will be, later on today, we will develop the theory that you already know of classification trees, and we will be able to actually do this in a mechanical way. But so even where we have situations where the data is misleading, if we are able to find some conclusions from that we believe in, then that is what we want to act upon. And that's an example of that. Okay? Now, let me tell you something which is also a source of confusion and misunderstanding, which is the concept of returns over time. The most widely used is the time-weighted rate of return. That's the name that is used, and it's the one that you're all familiar with. If I give you monthly returns, you can compound them monthly. So the time-weighted rate of return is the composition of the monthly returns as you're familiar. You just take the returns on a monthly basis and just compound them like that. This is the standard. Everybody uses this. And for us, this has very profound implications. I have another fund that I created here. I start with the dollar again, and the dollar that I put in, as you can see there on the inflow column, I see that I put $1 into my fund, and then the P&L that month is $1, so I make $1. That means I have $2. And the next month I start with $2. I have no inflows, but I have a P&L of $2. So the next month I start with $4. I have no inflows, and then I make another $4. And every month I can see that I keep on doubling my money. Every month I double my money. So I arrive at the month of November with $1,000 and change that I created by doubling my money every month. And at that point, my good friend Elon Musk decides to give me $1 billion to invest in my fund, and then I lose half of it. And after I lose half of it, I end up with numbers which are as follows. You see, I have an inflow of $1 billion, but then I lose $500 million, and then I get there. Okay, great. So that gives me a time-weighted rate of return, which is 102,300%. Of course, that's a big drop from 204,700% I had just before I lost the money. Right? So I will earn the Manager of the Year award for my great performance that year, despite the fact that I lost $500 million. Right? And you know why? What's wrong with this? Well, there's nothing wrong with it from a mathematical perspective. Everything you have here is correct. And if you put this into your spreadsheet, the numbers are correct. There's no mistake here. The mistake is in the perception. We think, once again, that statistics has some relationship to how we make money. And in fact, here we perhaps didn't make money, we lost money. You know what's going on. The month where I had the most amount of assets under management is the month where I lost the most. And it didn't have an effect on my cumulative rate of return because the cumulative rate of return does not take into account how much money is in my fund. So for that reason, there's another definition of returns over time, which is the internal rate of return. The internal rate of return gives me a return concept. These are all mental creations. They are created by humans. The markets have no room here. And the rate of return is defined implicitly as the number R that makes all of my inflows and outflows grow over time at the right amount, so I explain my net asset value in my fund today. Okay, as some of you may recognize in that expression the value of a bond as a function of the yield to maturity. It's exactly the same. You take P as the inflows into the fund and the inflows or outflows into the fund. So the inflows into the fund will grow at the implicitly defined rate R, so that the value of my fund today is the result of that growth. So if I go back to my example with that, I see that indeed, if I solve that equation, which is the one that should explain what my internal rate of return is, I get that my rate of return is roughly minus 50%. So these are, again, two ways to calculate the rate of return that give rise to very different numbers. And the key is not in calculating one or the other. The key is in understanding the meaning of either of them. And the difficulty every time we do these types of things in investing is understanding the meaning of what we're doing. What we're doing in this case is very simple. There's multiplications. Everybody knows how to do that. But interpretation is the problem, is where things are wrong. But let's use this to our advantage. And let me give you another two funds now, not one, but two. Let me walk you through them, because this thing we have seen here has some good consequences for us. If I look at these two funds here, I have the one on the top. They're invested on the same underlying asset. Could be a stock, an index, it doesn't matter. They're invested on the same asset. Both start with $100. The difference between the first and the second is in the first one, the $100, as you can see in the second column, they get invested in January and you don't touch it until July. So there's no, you invest and you go on vacation. In the second one, you invest $100 in January, but you don't go on vacation. You keep on working, you keep on investing. In the month of April, you see that you invest some more. In the month of June, you actually divest something from your fund. The first one is passive. The second one is active. The underlying is exactly the same. In fact, if you look at the monthly returns, are exactly the same for both of them, and both gives us an average return of 25% per month. Now, we've learned not to be impressed by that number already, okay? Yes, all right, we're not impressed by that. But note that although both have a monthly return on average of 25%, one of them does not make any money, the passive one does not make any money, and the active one makes $150, has over 100% return. And why is that? That's because the active management worked in the favor of the fund. In the second case, not in the first, because there's no active management at all. And I have some numbers over there. And what I would like to promote, a concept here, is a concept which is very elusive in the investment sector. It's actually a number that everybody talks about and no one knows how to define. This has a term, this has a meaning. It's called market timing alpha. What does that mean? It's an investment term that people use in the investment sector, and it refers to the ability of certain managers to know when to buy low and when to sell high, which is the holy grail of investing, to buy low and sell high, and no one knows how to do it. In fact, no one even knows how to measure if that's what you have done once you have done it. Understand what I'm saying? Okay. So I have my proposal. It's coming in the next slide. This is my proposed method to define market timing alpha. But that's less interesting than for me to have you understand the difference between these two investments here. Yes? Okay. So how can we attempt to measure market timing alpha as an indicator whether someone has the ability to know when to buy low and when to sell high? So I have a proposal for you. How about if we look at the difference between the internal rate of return and the time-weighted rate of return? It gives us a measure of perhaps that. So I'm going to leave it there. This is not accepted in the financial sector. In fact, I'm telling you, in the financial sector, no one knows how to measure this. People talk about it, and then they engage into big fights whether that was market timing alpha or not, because no one knows how to measure it. Of course, you can come up with lots of algorithms based on databases, and you may think this is what it is, but there's no agreement to that. So I'm going to propose that as a very simple, very simple, rigorous definition that captures that. And of course, you can come up with counter examples of that, but at least I want to leave it there as a proposal, just to show you how powerful just the understanding of some of these concepts are, and how useful to have the ability to define something the way mathematicians define things could be when it comes to defining characteristics for fund returns, such as, for example, this. But I should tell you, this big disclaimer, I'm the only one who uses this definition, no one else. But I should also tell you, I'm the only one who uses any definition. No one uses definitions like that. Okay? All right. So I don't know if you are beginning to feel powerful, but we are now en route to becoming very powerful, at least in our ability to detect a nonsense which is put in front of us. Now, on our hike to becoming more powerful, I need to stop talking about individual investments or individual stocks or individual assets and talk about relationships, which is where the magic of investing is, relationships. Markovits has a famous sentence. He says, the only thing which is free in finance is diversification, because it leads to risk reduction. And as we saw from yesterday, risk reduction is just as good as return enhancement, is the same. And that was Markovits, who's going to be, well, I'll talk about him a little bit more. Now, you already know that. You know what the covariance between two random variables or two assets is. I don't know if your definition looks like this or is different, but it's exactly the same thing. It's what we do is we take the expectation of the product of your deviations between your mean. So if you go up and down at the same time, you're positively related. And if you go down and up at different times, you're negatively related. We already saw that when we flipped coins yesterday. And you know the definition of correlation, which is the division between the covariance and the individual volatilities of each investment. And the advantage of correlation is it's a number which has no units. It's always between -1 and 1. That's why people use correlations more often than covariances. Covariances encodes two things into one, and that's troublesome. It encodes your individual variability and your relationship with others. So we like to decouple the two, and the covariance gives me the relationship measure with others, and the covariance and the volatility gives me my own. My own volatility. So that's why the correlation is the one which is used most of the time. And both of them are rooted on very good heaven and earth versions. So these are things which we can work with and we can believe, although some people still. And the correlation matrix or the covariance matrix is also useful for us to calculate the portfolio volatility, the portfolio correlation, a formula you have seen many times. If I take my portfolio consisting of investments of certain amounts W into certain assets X, the volatility of that portfolio is obtained by taking that cross product and the expectations and the covariances, which I can express in terms of the volatilities and the correlations between the assets. And the result is this expression I have here, which is the matrix multiplication between my asset weight vector, and my variance covariance matrix. And this is, you have seen that, you probably have seen the risk matrix methodology. This comes up all the time. This is also the same formula that you have when you when you add Gaussian random variables. The result is a joint Gaussian random variable exactly given by that, by S covariance matrix. This appears all the time. But now, this is going to be the foundation for something very important for us, which is the big development that happened in 1952 by Harry Markowitz when he was a graduate student at Stanford. He's credited for being the first one that came up with the concept of risk when it comes to investing. That is actually not true. He wasn't the first one. He was the most successful, because perhaps the first person that came up with the concept of risk was Bernoulli 100 years before. And he's the one that considered the standard deviation as the measure of risk. But Bernoulli was Swiss, by the way. Okay? But when you come up with a definition like that in 1850, it's pretty useless, because how can you calculate it? You need to hire armies of accountants or armies of mathematicians to do the calculation for you. It's not useful. So the reason that Markowitz is credited with it is, on the one hand, as we will see, it was financially very mature. It wasn't just a definition, but also he did it at the same time as computers were being developed. So his definition had much more impact than the one by Bernoulli 100 years before. Right, 100 years before. Okay, so you already know what he did, I suspect. And what he did is a massive exercise in data compression. He said, investing is very difficult. Let me make it very simple. Every time I look at an investment, I only care about two numbers: the expected return and the standard deviation. We've already seen that neither of these numbers are to be trusted. But let's put that aside for the minute. Okay? Let's say that this is where I care about my investments, because once you do that, then investing becomes a very simple exercise, because it's just going to be reduced to a simple exercise of picking a point on a plane. I'm going to oversimplify what he did, but this oversimplification is very useful for us, because he did a very simple explanation of the importance of that, things that you already know. This is the capital asset pricing theory model, the capital asset pricing model. If you look at a very risky asset, for example, a stock, and you put all your money into that, well, you have a very high risk, but you also have a very high return. And you can decrease the return and decrease the risk by adding some less risky asset like a bond. And what you have in that curve is the result of adding more bonds to a stock portfolio. And the surprise happens that the least risky portfolio occurs not when you have only the less risky asset, like a bond. No, it happens when you have a little bit of one and a little bit of the other. In this case, it's 75-25, 75% of bonds, 25% of stocks. Why? Because stocks and bonds are not perfectly correlated. So because of the matricial formula we saw earlier, adding a little bit of an asset which is less correlated to yours will lower your risk and increase your return. And this is what Markowitz referred to as the only free lunch that exists in finance. Okay, now you have seen that. This is the capital asset pricing model. And the result of that is the Markowitz theory of investing, which is the world of investments, which is on a plane, is divided into two groups. The groups that contain the real investments and the groups that contain the make-believe investments, the impossible ones. So because of that, a consequence of that is the rational investor will like to invest on the boundary between the two. And you have seen that. And this is the Markowitz theory. And Markowitz doesn't tell us where to invest on that coastline. Okay, you just say invest in the coastline, but not where. And then Sharpe came and told us where to invest in the coastline. And at this point, I need to make a very important point. You already know this. In fact, the Sharpe ratio also occurred yesterday. But I want to share a personal story with you, which is going to be the basis for something which I think is very important that I want you to understand. I want to use this to explain to you how the financial sector works. Very, very important. As I mentioned to you yesterday, in 1999, I created, with a partner, my first spin-off company, an investment company. Okay. I had just been introduced to mathematical finance myself. I came from mathematical physics, a different topic, but I studied to learn finance. And there was one thing I never understood. I'd never understood the definition of the Sharpe ratio. You all know the definition of the Sharpe. We saw it yesterday. You take the expected return and divide it by the standard deviation, right? There's something very wrong in that expression, which is the reason I never understood it. I never understood it because the expected return divided by the standard deviation is not a unitless quantity. It has units. It has units of time to the minus a half, right? So interesting ratios typically have no unit, right? So I really never understood. It's a very simple definition, but I never understood the use of that or why the Sharpe ratio was so important. I never understood. And I had read, of course, the papers and this, but it still didn't make sense. It only made sense to me when I started my investment company, because I saw how people get paid. And that's what I want to show you now. I want to explain to you the Sharpe ratio from a very realistic perspective of how people get paid. I know we talked about money yesterday. Well, we're talking about money now. And we're talking about money so that we can understand the Sharpe ratio. And not only, you will see, not only will we understand the Sharpe ratio, we'll understand how the financial sector works. Sorry, we will understand how the investment sector works. And we will see that the investment sector is divided into two people. Only two. A and B, you will see. And for that, I now need to hire two people that I'm going to give an employment contract. Who wants to be my first employee? Great. Okay, you're catching up speed. So your name, I'm going to go with him. Matthias. And you're going to be my next employee, all right? Matthias, right? So Matthias is going to be my first employee. And Kali is going to be my second employee. So Matthias, you're my first employee. All right, so I'm going to hire you as a portfolio manager. I'm going to give you some money to manage. 100 million, a billion, it doesn't really matter. It's not important. But you're going to, let's say $1 billion, okay? And I'm going to pay you, as yesterday, a fixed amount, 150,000 francs per year. But if you make 5% or more, I give you 1 million francs bonus. Some of you may think that's not enough, but let's not worry about that. Let's say 1 million. Yes?
Agreed.
If you make 5% or more than 5. Sorry?
And if it makes sense, still 1 million?
Same, 1 million. By the way, this is how people get paid, okay? You typically are given a target. If you hit it, you get your bonus. You don't hit it, no. If you exceed it by a lot, you go, oh. Okay? That's your employment contract, right? Perfect, good. So you're hired. Let's go. You go to work. You go to work tomorrow. At what time do you go to work?
7 a.m.
7 a.m. Very. What time do people go to work here in Zurich? Do you know?
Depending on the industry.
Yeah, in the financial industry.
In the financial, they go at 8, I think.
8? Oh, okay.
In the media industry, they go at 9.
9, okay. You know, there's a very, there's an algorithm to find out when people in the financial sector go to work, which is look at what time the Starbucks open. Yes, in New York, they open at 6:30. Some open at 5, but most of them open at 6:30. In San Francisco, what time do you think they open?
7.
Eh?
8, 7.
No, 3:30. 3:30. Yes, people go to work at 3:30. Yes. Mm-hmm.
When do they leave?
What time they go home? About maybe 4 p.m., 3, 4 p.m. Yeah.
In San Diego?
Well, this is in the financial sector, you know. We had managers in California, and yes, no, at 4 they're working. They're already in the office, and you call them, and they are there. Or they have to be, right? Because they trade the same market you trade. Well, if you trade Asian markets, then they do the opposite, right? They would go to work late and work through the night and go home. But if you trade in the American markets, then that's. But the Starbucks open at 3:30, so the Starbucks always know when time people go to work. In North America, everybody goes to the Starbucks. I guess here you have better choices than Starbucks, right? Yes, good. No. But anyway, so you go to work at 7. That's okay. It's half an hour too late, but that's okay. That's okay. All right, and then what do? You sit there, and then what do?
I manage, I try to buy good stocks,
Try to. There's only one thing you're thinking about.
to win my bonus.
Exactly. You only think about a million francs. That's the only thing that's in your mind. You frankly could not care less what's on your portfolio as long as you take a million francs home, right? Exactly. That's what you're thinking about. So how can you create a portfolio that will give you a million francs?
But is that 5% internal return or what? How is it measured?
5%. Simple. Let's not make it complicated. Okay? 5%. So you have a $1 billion portfolio. If you make $50 million for me, I give you one. That's it. Okay? So let me help you. I'm going to write it down in math for you. What mathematicians are very good at is when we don't know something, we give it a name, typically a Greek letter. So your portfolio, which we don't know, I'm going to call it pi, capital pi. We don't know it, but we call it capital pi. Mathematicians have a license to do that. They can give names to things that sometimes don't even exist. They can do it. We do it all the time, right? And that already makes you believe that you're closer to the solution because you can give it a name, capital pi. And then you just write your bonus in mathematical expression. You want your portfolio to have a return bigger than R. R, I say, is 5%, but I write it as R. It's your bonus. It's in your contract. R is in your contract. Pi is nowhere on your contract. Pi is what you are going to build. And you want to maximize the probability that you make your million francs, and you don't care about anything else. You just want your $1 million, or francs, or euros, or something. Francs. Okay, you want your million francs, exactly. Right. Okay, so you don't know what it is. You call it pi. But the thing is, you start to do some math. Because you don't know the portfolio pi, but the portfolio pi, if it's reasonable, should have a mean return, mu, and a standard deviation, sigma. And log return, simple return, let's not get bogged down with that just yet, okay? It'll be self-evident when we finish. And since we don't know what they are, we do what mathematicians do, we give them names too, Greek names, mu and sigma. And then you realize that you can subtract mu and divide by sigma on both sides of that inequality. So the probability you make $1 million francs is the same as the probability that pi minus mu divided by sigma is bigger than your 5% minus mu divided by sigma. Right? And then you have an idea. So my God, if my portfolio happens to be Gaussian, okay, no one guarantees that for you, but this is your first day at work. You can assume it's Gaussian. On the second day, maybe you consider a portfolio not Gaussian, but the first day, it's okay. You can. If the portfolio is Gaussian, what you notice is that that expression we have there is independent of the portfolio. Because the portfolio minus b divided by sigma, that's a Gaussian distribution. It does not matter what the portfolio is. So it should equal that expression we have there, where phi is the cumulative distribution function of the Gaussian distribution. So you wrote the probability you make the million Swiss francs as a mathematical expression involving only two parameters, mu and sigma. So the result is that you need to maximize that number. That will maximize the probability that you make a million Swiss francs. Almost everybody in the financial sector is paid like that. Therefore, almost everybody in the financial sector likes to maximize the Sharpe ratio. By the way, not with R, the risk-free rate of return, as you may see in some books, or as Sharpe himself argued. No, R is what's on your employment contract. Right? Everybody sees that? I need everybody to understand this. This is very important. Everybody needs to understand that. And it's very easy to understand. Everybody, yes? Everybody understands this? Good. So you know what to do. You maximize the Sharpe ratio. How do you do that? Hold on, okay? Because I'm going to hire another person, and that's going to be Kalia. You're going to work for me. I'm going to give you another employment contract. Your employment contract is very similar. You also have, what, 1 billion Swiss francs? But now you have to beat what's the name of the Swiss stock index?
SMI.
Which one?
SMI.
SMI.
Right.
So, okay, so you have to beat the SMI by 5%. Okay, and if you beat it by 5%, then you get 1 million Swiss francs.
That's way harder to do.
Oh, hold on. Thank you for your opinion. It is exactly what I thought you would think, but hold on. Maybe I change your mind. Let's say, what time do you go to work?
7.
7, okay. So you go to the Starbucks together, and then he goes to his office, you go to your office. Great, perfect. So let's write your contract in mathematical terms. It looks, as Simon says, it looks more difficult, right? It looks more difficult because in your case, if I write it down, of course, same thing. I don't know the portfolio, call it pi, right? The index I know, I call it y. Okay, since I know it, I call it a Roman letter. If I didn't know it, it would be a Greek letter. Okay, so the probability that your portfolio exceeds your index, SMI, y, plus 5%. That's all you want. You don't care what's in your portfolio except that. But like him, you can start to realize that you can give names to some of the quantities here. And your case is slightly different. You're going to take the expected performance of your portfolio minus the expected performance of the index, neither of which you know, but you call it Greek letter names, mu. And then you have to look at the volatility of the difference of performance numbers between your portfolio, which you don't know, and the index. Right? And we call it sigma sub pi minus y. And that number has to be bigger than your 5% minus the mu of the difference divided by the sigma of the difference, right? And now you can invoke the same thing he did, because now you realize that this is independent of my portfolio. It's another Gaussian variable. Therefore, can be written again using the cumulative distribution function of the Gaussian with a slightly more complicated argument inside it. And to optimize the probability you make 1 million Swiss francs, what you do is you optimize what's inside that. Now, have you seen this before? Have you seen this ratio before? It's not the Sharpe ratio, it's a different one. Have you seen it before? It has a name, it's called the information ratio. And what's at the bottom is what makes the difference, is the tracking error. The tracking error you may have seen, because it's used in engineering, is the standard deviation of the difference between the two investments. So now I need to see something very important. If you are If your return is very different from the index, you will not earn your bonus. In fact, you will be fired. Even if you outperform the index. In the mutual fund sector, you're compensated directly and indirectly if you track the index very closely. That's how it works. That's how it works. In fact, let me optimize your portfolio right now in an approximate way, using only my hands. No formulas, no mathematics, no nothing. Just thinking. Okay? We're going to use the supercomputer inside your head to solve this optimization problem. And the key is to understand that your tracking error has to be very small. So how about this? You buy futures on the SMI index. You know what futures are? Futures? You buy a position on the index. It's a futures, so that when the index goes up, you make exactly the same amount of money as the index. The advantage of futures, you can buy futures with very, very small margin requirements. In fact, I want to say that you have no margin requirements. Let me allow that. It's a 5% error, it's very small. So you take a futures position on the index, which is for free. Raise your hand if you don't know what a futures contract is. You do not know? Anybody? You do not know what a futures contract is? No? Okay. So a parenthesis, let me explain to them what a futures contract index is, okay? It's a contract that if the index is at 100 today, you decide what the value is, say in a year, and you agree to buy it at, say, 100. So if the index goes up, you can buy it cheap, you make 5 if it goes to 105. And if it goes to 95, you lose 5 because you have to buy it at, sorry, the other way around. That's why I never make money. I always confuse making and losing money, okay? If the index goes, no, you're right. Yeah, no, I was right. If the index goes to 105, you make $5 because you are forced to buy it at 100. But if it drops to 95, you lose $5 because you're forced to buy it at 100. It's an obligation you have to buy it at a futures price. That's a futures contract. You can argue that when you buy something on Amazon, it's a futures contract because you pay for it now and it gets to you like in 2 days, right? It's like that, but for financial instruments. And you can say this for a year. So you can buy that. You can buy futures on the index for a year. That guarantees that your tracking error is very small, say even 0. But you still have your billion Swiss francs in your portfolio. So what do? Tomorrow, when you meet him at the Starbucks, you said, hey, how about you manage your $1 billion, and if you make 5%, you give him how much? Let's say 500,000 Swiss francs. What do you say?
No.
Why?
Because I believe I can do the 5%.
No, sorry. I don't think you understand. Her proposition is very good. You're going to manage your billion Swiss franc portfolio anyway. Now you have another billion euro.
Okay.
Now you manage 2 billion, right? And if you make your 5%, which is the same amount of work for you, now you don't make 1 million Swiss francs, you make 1.5 million Swiss francs. Oh my God, don't let that opportunity pass. It's a good opportunity. It's good for you too. Why?
Because they're minimizing my risk.
Because now you say, okay, then you go on vacation to Brazil tomorrow, you're there for a year. You spend your 150,000 Swiss franc income on being on the beach for the whole year. You don't have to do anything, right? And he does all the work for you. Understand? Great. Now, that works for the first year. The second year, you're very bored. You say, my God, I already was on vacation for a whole year. I need to work. I need to do something. Then you realize that what you should do, what should you do? You go and you talk to everybody who has money. You say, why don't you give me money? And I will beat the index by 5%. And if I get it, you give me some big number. And if not, that's okay. I don't charge anything because they're going to give it to him. And then he's going to be piling up with assets that he has to manage and obtain 5% return. And what are you doing? You're just selling. Because he will do the management for you. Okay? I suspect I'm going to be interrupted in 4 minutes by the bell, which is good because we just got to the top of this hill. In the investment sector, there's only two types of people. The Kalias and the Matthias. Only two. They work to obtain cash returns, absolute return strategies, okay, cash benchmark, and Kalias that really don't do anything, they just sell. Because then he will do the management for her. You understand? And this is only a little bit exaggerated, not very exaggerated. He has a name, he's an alpha producer, and you have a name, you're a beta producer. Simon.
So I just didn't understand 100%. So she has the future option. Let's say she decided to buy for 100, like said, it's like I will buy in 1 year for 100. But did she then not spend already her money?
No, the futures contracts are free.
Oh, okay. And so you could screw it in a year or not?
Hmm?
You're just in a good or a bad situation in a year.
So in a year, the futures position is guaranteed to give you exactly the same return as the index. Exactly the same. Like zero difference, right? So after a year, she says, okay, I got my index return. Matthias, what have you done? She said, I gave you a 5.5% return. Great. You collect your million Swiss francs, you give half to him, you keep the other. But you have done no work.
But just if the index went up, if the index went down, then
Same thing.
she lost like if she said
imagine the index went down 10%. Her futures position went down 10%. He made 5.5. So she made index returns plus 5.5. She was down 4.5%. She gets a million Swiss francs bonus. Yes, you do get paid for beating the index also when the index goes down.
But if he did a bad job, then no.
That's it. So he doesn't get his bonus. She doesn't get her bonus. Each of them just collects their monthly paycheck, and that's the end of it. And this is how the investment world works. And I like to say that we have two types of managers here. We call them alpha and we call them beta. Alpha is the Matthias of this world. Includes absolute return strategies, it includes hedge funds, it includes all these things, prop desks. And then we have the betas, which are the Kalias, which includes all the mutual funds, all the private equity investments, and this and that. Okay? And they're all like that. There's only two types. Now, these are important consequences. We will get them after the break. So with this example, we've learned a lot of things. We have climbed a hill from which the landscape is now very interesting. We have, on the one hand, seen how we can manage two very different types of portfolios. Those which are cash benchmark, absolute return, on which those which are based on indices. And this gives us a division of the asset management industry into the alpha producers and the beta producers. But it's going to give us much more than that, because in this is called alpha beta separation. In this process, we have made one fundamental assumption, which is that the portfolios were Gaussian. If they're not Gaussian, then everything that we did on the first day will break down. So we're going to have to get over that. There's another thing that has happened, which is indirectly there, and that is we have a linear relationship between, in this case, your portfolio and the index. So the linear aspect of that is also built into what we have done. As we take this further into the whole investment sector, these are the two things that we need to overcome. We need to overcome the Gaussian aspects of what we are dealing with, and we need to overcome the linear aspects of what we're dealing with. Both are very difficult. And what I'm going to do now is I'm going to show you in the second half of today the different attempts that exist in both of those areas. I don't know how much of this I will have time to finish today. I hope I can finish everything. If not, I will continue tomorrow. My hope is to finish everything that I'm aiming to do today. The Gaussian approach, we're going to delve into the part which is usually done, which, as you will see, is 100% nonsense. But I'll tell you anyway, because I want you to know why it does not work. And the nonlinear aspect of it is something that we will be able to understand fairly well with techniques from machine learning. And I will be restricting myself to random forests and tree-based approach, tree regression and tree classification. That's the plan of what I have in front of me today. But I want you to look at it from this perspective of the two portfolios we just built, because from that we understand, and we will be able to make these things into a very practical way. By the way, if you ever get a job in the financial sector, in the investment sector, always very quickly try to understand if it's like that or like that. And if you have any doubts, look at how you get paid. That will be the best indication of what it is that you're doing, okay? All right, so let's continue going forward. I will stay first with within a linear world, and we'll see in the linear world what we can do. I'll introduce the concept of market factors and this and that. The first thing that I have here for you is a reflection that the alpha production, Matthias is our alpha producer, the alpha activity, what it does is it shifts the efficient frontier of Markovitch further up. That's what it does. It just does a parallel translation of that. And there is a graph that summarizes very well the two approaches that we have. Kalia lives in a world of very high correlations. As you know, stocks are very highly correlated, which is an advantage for some of the things that I'll discuss now, because these linear models work very well in highly correlated worlds like yours. And we're going to see how that works. Your world, because of your benchmark compensation, lives in a world where cash-driven strategies are very uncorrelated. And for you, the linear models are really not going to work very well. We're going to see that. I will have a way of classifying these two approaches as I talk about them from a linear perspective into music and noise. And I will be able to prove to you mathematically that this is the right label. So Kalle is going to be the source of music, and Matthias is going to be the source of noise. And that's going to be something that will develop the mathematics of that. And we can see that by looking at the variance-covariance matrix. The variance-covariance matrix of Kalia's world is one in which the correlations are always very close to 1. And linear models work very well there. And you already know that if you invest in mutual funds and look at how they always do the same. Why? Because they all have to have a very small tracking error to the index anyway. Whereas in your case, this is different types of investments. You may not have access to them, but there you're going to see that the variance-covariance matrix is going to be very, very diversified with numbers which are very, very close to 0. Okay? The beta world and the alpha world. Okay. So let me talk about how we approach this from a linear perspective. Again, the linear restriction is the last one that we'll remove because it's the one which is most convenient. Regression analysis helps us understand what we are doing. In fact, I could say from a regression perspective that Kalia's portfolio was the index plus alpha. right? And that means that I could then go beyond the type of portfolio that you built, where I can add not just, say, an index, I can add inflation to it, I can add geopolitical events, I can add volatilities. That's all beta. And you are the one that you don't care what's going on outside there. You are the alpha producer. By the way, we saw the ideal alpha product yesterday. There's no fund. You don't care what happens in the markets. You're going to obtain that 7.2% return unless they say major catastrophe, right? So that's the world that we developed yesterday. Without knowing, we created one of the best alpha products we could have done yesterday, yours. Today, we're going to focus on how to understand the market relationships that most investments have, because what we did yesterday was exceptional. And the market factors are the way we use to explain what returns are. Okay, so I'm going to spend the first 45 minutes talking about the traditional approach to this, and then I want to use the rest to show you how machine learning is used to extend this into the nonlinear world and other things. So linear regression is something that you already know. If I give you, for example, this would be a very good depiction of, say, Kalia's portfolio. At the bottom, you will have the SIM model, SIM? SMI. You have the SMI index at the bottom, and then yours will be the one on top. And if that is 5%, then you get your million Swiss francs and you're happy. And you know that from a linear regression perspective, this has significance. You obtain this through a least squares regression. I'm not telling you anything that I'm sure everybody knows this, right? Yes, linear regression is okay. But I still want to tell you, because linear regression is how we start to build our models. And later I will be doing the nonlinear regression, or the tree regression approach, which will be very powerful. But at least make sure that we all understand. My index will in general be represented, my investment will in general be represented as an alpha portion, that's the Matthias. And then the benchmark, which is where I use to detect what my dependencies are. And this is obtained through the least squares regression methodology that you have already seen. Okay, good. This is all known. You can do this in several dimensions. You can figure out your exposure to commodities, interest rates, stocks, and this and that. All right. So market factors can be understood from that perspective, from a regression perspective. But my interest is into understanding now the internal structure of market factors. And this is something which I want to do using spectral theory. And here is where there's going to be a diversion, the linear and the nonlinear. I want to exploit the linear. There's some very important facts about the linear that I want you to know that will be very useful when we go for the nonlinear. And I like to start talking about the linear market factors, understanding the fixed income markets. Things that you probably know, but I'll act as if you don't. What I have here for you is, let's say that I look at the yield curve of a fixed income market 3 consecutive days, and have them in different colors: red, green, and blue. Let's say that today is red, tomorrow is green, and the day after is blue. Or today is red, day before, so yesterday was green and the day before was blue. Okay, whether I'm looking forward or back, it doesn't matter. How can we understand what's going on in here? Here we can clearly see that interest rates are going up. If this is today, tomorrow, and the day after, right? But interest rate is not a number, it's a whole curve. So the whole curve is going up, but as you can see, it's going up different amounts at different times. So this is a linear model that can be obtained through a decomposition of a main movement, which is the parallel shift, a second movement, which is the curve tilting, and the third one, which is the convexity. And there's almost nothing beyond that. Almost nothing beyond that. The parallel shift is the most dominant move, when interest rates move, typically they all move at the same time. I'm about to talk about music, so this was 5 minutes too early. You will see. Okay. All right. I guess I continue, right? It's not a signal. I don't know the code. I don't know the music code here.
I think it was half an hour break this time. No, guys.
I don't know.
4:15 until yes. So now you got some extra time.
Okay, so I continue. Yes, yes. Okay, I don't know. All right, I continue. So the movement of the yield curve is a very well-known superposition of these three movements. You may have seen that. It's very well understood. It is okay. I'll come back to this. Okay. When you move to the stock market, things are more difficult to understand, but this is how you do it. What I have here is an example of, I know there's a lot of numbers out there, okay? I'll tell you which numbers to look at. What I have here is 10 stocks, a universe of 10 stocks. It could be your portfolio or it could be your index, 10, only 10, because I want you to be able to see everything. When you have 10 stocks and you want to understand the internal dynamics of that, what you do is you construct the matrix of its eigenvectors. So how to do the eigenvalue, eigenvector decomposition. Now, anybody does not know what an eigenvalue and eigenvector are? Everybody knows eigenvalues and eigenvectors? Yes? Good. All right. So let me ask you, if you take a variance covariance matrix of a stock's performance, what do you get? What's the first eigenvector? What's the eigenvector with the largest eigenvalue? Do you know what that is?
First principal component?
Yeah, it's the first principal component, and that is also known as the index. You get the index. Yes? The eigenvalue with the largest, the eigenvector with the largest eigenvalue is the index for the stock market. There's some reasons for that. You may have seen it's the variation principle, is the one that maximizes the internal correlations. Yes, yes. I have it here for you. Okay. In fact, when you look at, I have the eigen values on the top, but you see the eigenvalue are given in weird units. So what I have done is I've taken the eigenvalue and divided by the trace. The trace is the sum of the eigenvalues. When you look at the eigenvalue divided by the sum of the eigenvalues, I get that the large one is 55.7%, just over 50%. What that means is that that eigenvector is responsible for about 50% of the movement of the stock market on a given day. It has that explanatory power. And that's the eigenvector. This is the market movement which is responsible for that. And as you can see, this is very close to the index, to an equal weighted index. You see, all the numbers are the same. Some of you may think that they're not the same because you may think that 0.27 and 0.31 are different numbers. No, they're not different numbers. They're the same number. Okay, all the numbers are more or less the same. And you probably know that whether they're positive or negative, it doesn't matter because eigenvectors are determined only up to a multiplicative constant. This is what you know about eigenvalues and eigenvectors, correct? So here you can clearly see the index, the stock index. And you can clearly see the significance of that is very strong. Now, what's the second eigenvector? For a stock index. What's the third? Okay, I rewind. We mentioned yesterday something, and you said that you know it. So you knew the Fama-French model, yes? Fama-French sounds familiar? Raise your hand if Fama-French is familiar. Raise your hand if it is not familiar. Okay, so Fama-French is a market decomposition that has to do not by the famous French, no, it's by two people, Eugene Fama and French for his first name. And it's a decomposition of the market movement. And what they say is that the first eigenvalue corresponds to the index, which we know. The second and the third correspond to value versus growth and large cap versus small cap. Sounds familiar now? So there is a way to invest with that type of exposure. In fact, now I could have another employee like Kalia, who wants to be my next employee. I pay well. Simone, you're my next employee. I could say, you know what, you're my growth versus value investor now. So I give you a value versus growth benchmark, which will be what? Will actually be very close to an eigenvector. I'll have to construct it in the Fama Friends. I'll say, that's the one that you beat. And if you make 5% above that, you get 1 million Swiss francs. Now, what do? You're good friends with Kalia, you went to school together, said, how did you do yours? Well, I hired Matthias. Oh, I want to hire Matthias too because I want to go on vacation. And then you go and you say, well, can someone give me a futures contract on value versus growth? And the answer is no. So bad luck, you have to work. Doesn't work, right? But at least, yes, but now he's going to have to do something very unusual because when I give you the benchmark, you say, well, damn, I just buy those stocks, that's my benchmark. But when you buy the stocks, you have to pay, you have to actually spend money on the stocks. It's not like her that can get them for free, right? So now you have to work. But now someone is overhearing this conversation, and who wants to do a startup? Any startup guys here? Startup guys? No, you're already working. You can't leave your job right now. I need someone else. Someone wants to do a startup? No, you have time? Okay. No startup people here? No? Oh, you're not going to be rich. Okay? You're going to make $1 million every once in a while. But, okay. Cyprian, let me be your startup. So you're the startup guy. You're there. You look like a dot-com tycoon. Say, well, she needs something. So now you have this system. You create a synthetic index on value versus growth. I said, you know what? I sell it to you because I have this mechanism here that I can do this and that. And then you're good friends with some bank that will give you the execution so you can do. Now you create a very interesting fintech. You sell it to her now so you can buy the futures through you. You go on vacation. And we replicate what we did earlier. This is the beauty of the linear models. And today we still live in a linear world. The investment world is still linear. Okay, it's not non-linear yet. We will see what we can do with non-linear. Okay, but it's sophisticated linear, like that. And now everybody makes money. You make money. You go on vacation. You make a lot of money. Everybody gives you the money to manage, right? But for that, we need to understand what that is. And in the case of the stocks, it's a bit complicated. That's why this is a good business, and you can do that startup. But what Fama Friends tells me is that those two factors, like value versus growth, they are hidden here somewhere. That's the spectral view of the market. Back to the fixed income world, let me tell you how we would do this, because it's very pretty. What I would do is, if I look at the yield numbers day by day, that gives me a time series of vectors. It's a vector time series. So from the vector time series, I can construct my time series of returns. I have to look at the returns of the yields, and the reason is statistical. That is an autoregressive system. It has a unit root. If I just do the correlations like that, it's not going to work. Sorry, end of the footnote. I go to my variance covariance matrix and I diagonalize my variance covariance matrix. And that gives me the factors that I need for my fixed income market. And I have my eigenvalues and my eigenvectors in decreasing order. And I know what they are, because those are the descriptions of my market dynamics. And what are they? I already told you. The first one is the parallel shift all once, like the stock index. The next one is the, by the way, this is what, each of these risks gives rise to a risk factor. And that is the duration risk, very famous for having blown up Silicon Valley Bank a few years ago. Remember Silicon Valley Bank? Did you follow that? Well, that's the risk factor that killed Silicon Valley Bank. That's how important it is. The second eigenvalue is this one. +1, +1, +1, -1, -1, which is the curve tilt. By the way, that's the one that predicts recessions. When the curve flattens, that signifies that a recession is coming in the business cycle. We don't care because we're not doing economics, we're doing investments. And that is the risk factor that killed Orange County in 1994, went bankrupt because of that. That was the risk factor that killed Orange County. The third one is the butterfly spread, is the convexity, is given by that eigenvalue. Sorry, the eigenvector. And this is a very obscure event, but that sent a hedge fund, Beacon Hill, in 2002 also bankrupt. So these are the risk factors that can kill you. They're also the risk factors to which many investors are pegged to, and their performance is tagged to this, just like you were pegged to value versus growth. And now I can start to distribute jobs for everybody here, where your objective is to do one of these things. And these are all index-driven investing. But at the end of the day, you'll have to go to Matthias, because he's the one who produces the alpha on top of this. Okay? And the people like Matthias are called hedge funds. They are the ones who have no benchmark. We spent the whole day yesterday talking about them because our snow fund was one of them. And we can see them because if you do the eigenvalue decomposition for, say, the mutual fund industry in blue or the hedge fund industry in red, you can see that in the hedge fund industry, there's a lot of disorder represented by the fact that there is no real dominant direction. Whereas in the beta world, we have a very dominant direction, the first eigenvalue, and everything else is noise. Okay? That's the music, that's the well-ordered world of Kalia and Simone. And then you have the noise, the very well-known space where Matthias makes all his money. Now I need to bring you to the year 500 before Christ, BC. Yes, there's a very interesting discovery that Pythagoras did, which is very relevant for us to understand what we're talking about here. And Pythagoras, on his way to school, he had to walk in front of a forge. A forge is where they make iron rods, swords, who knows, these kinds of things. And he was mystified by one fact, which is that as he walked in front of the forge, he would hear the noise produced by the forge operators hitting on those iron rods. And then he saw that sometimes the sound of the iron rods went very well with each other, sometimes they didn't. And he got very curious as to why. And he discovered something very important, which is very relevant for what we're trying to do here. Now, for this world of linear investing, which is, he discovered that if I take two iron rods and I write down their lengths by two numbers, PQ, if the ratio between these lengths is a small number, or you can write it with very small numbers, P and Q, then it sounds very good. And then he saw that if instead you need very high numbers, P and Q, to write the ratio, then it sounds very bad. He discovered that. He was just curious. He measured the iron rods and made some experiments. And this was the beginning of the Pythagorean theory of music, which had a very interesting application. You probably know that the square root of 2 was a very important number for Pythagoras. It's a very important number for us also. We will see how important it is for us today. Okay? And then he knew that if you take two iron rods whose proportion is the square root of 2, then the square root of 2 is a number which cannot be written by rational numbers. In fact, it's very far from a rational number. Those of you who do Monte Carlo will probably know that this is a very good number for Monte Carlo simulation. And the reason is that it is not very well approximated by numbers p and q being integers. So from the Pythagorean theory of music, this number should produce a not very pleasing sound. In fact, anybody here plays the piano? You play the piano? Do you know what that is? I want to show you the linear theory of investing with my piano. This is Pythagoras 2,500 years ago. That's that. The square root of 2 was a very important number for them. And according to his theory, this should create tension, and it does. Every musician knows that. And the reason is that you cannot approximate this number by a small fraction. But this is a small fraction. In fact, it's very nice because you can actually one resolves into the other. Yes, it works. Well, the reason it works is because of where these eigen values are in the sequence. So if I can use the analogy, the first chord is his chord, it's the cash chord, and yours, the second is the nice one. This is the index chord. Let me explain why. If you understand this, you will understand a lot of things, and then we can go to the nonlinear theory. Okay, but we need to understand the linear theory first. So I remind you, that's the chord. So we have two chords. One which are very far from each other because the ratio of the lengths is an irrational number, it's the square root of 2. And the other one which are very close to each other because the ratio between the lengths of the strings are very close to each other when it comes of viewing them as a rational number. So you live in a world of noise. You are the, by the way, this chord is very famous in the Renaissance. It was called the tritone. And every musician knew that when they wanted to depict the devil, they used that chord. Okay, that's so many stories. And you listen to music and the devil shows up, the tritone is there. Okay. All right, good. So, and this was done with this concept in mind, which is because this was related to Pythagoras' theorem. I don't know if you know that, because you can think of A and B as your eigenvectors, right? And the fact that the eigenvectors are orthogonal to each other means that Pythagoras' theorem works. And you know that works in 2 dimensions and in 3 dimensions, and it works in infinite dimensions. And in infinite dimensions, that's how we call them. This is Parseval's identity, right? I don't know how much of this you know. It is important, it's very important, because this is the spectral decomposition. This is the pinnacle of the linear theory. And this works in financial markets too. And in fact, it's so interesting that you can decompose any sound as a superposition of these fundamental frequencies. These are fundamental frequencies that work for every one-dimensional instrument, like all of these, for example. So some people play, who plays music here? What do you play?
Flute and piano.
Flute and piano, one-dimensional instruments. What do you play? Piano, one-dimensional instrument. Anybody else? I play the violin, one-dimensional instrument. What do you play? A little bit of guitar.
Drums.
Drums, thank you very much, because the drum is a two-dimensional instrument.
Okay. Yeah.
It's a two-dimensional. What kind of drum do you play? Maybe you play a one-dimensional drum. It's good. It's two-dimensional. Is it? What shape is it? A circle or a rectangle?
A lot of drums.
Each of them. What's the shape? Circle. Yes. Okay. Because if it was a rectangle, you know that the rectangle, although it's two-dimensional, it breaks down as one-dimensional and one-dimensional. It's a very simple two-dimensional. But the drum is very tricky, because a drum has eigenvalues and eigenvectors which are not like the one-dimensionals, which everything that I told you, the Pythagoras theory works because of sines and cosines. I'm about to show you that. Yeah, I'm about to show you that. But yours, the eigenvalues are Bessel functions. So your example, yours is nonlinear. Your example will be the analog of the nonlinear theory we'll have to do later today if I have time, if not tomorrow. The drums, okay? Or a trumpet. The trumpet is actually a manifold. This is also nonlinear. But all these are linear instruments. Yours is nonlinear. By the way, that's why it's so hard to tune a drum. Very hard. To get that perfect D sound on a drum, very, very hard, right? Yes, exactly. So all of this is exactly how financial markets work, and that's how we're going to give access to the nonlinear theory. Now, I have a nice corollary of this. This has really nothing to do with investing, which is why we have exactly 12 notes. You know that? It's a very nice coincidence, and the reason is that 3 to the power 12 is very close to 2 to the power 19. So that's where you can truncate the frequencies. We really have infinitely many frequencies or infinitely many notes. But only with 12 you can approximate all the notes very nicely. It's that if 3 to the power 12 was equal to 2 to the power 19, we'll have perfectly designed instruments with only 12 notes, but that's not the case, as you know, right? So that's it. But anyway, that's not important for us right now. Neither is the well template clavier by Bach. We're not interested in that. And we already saw that, okay? So let me go back to the world of investing by telling you that the reason everything works as I told you is because one-dimensional instruments, not yours, the drum does not play here, but all one-dimensional instruments have eigenvalues to the tension operator, which is the wave operator, which are given by sines. And the sines, as you know, have this shape. Yes? And these are the eigenvalues of the wave operator. The wave operator is what makes the string vibrate. The wave operator makes the drum vibrate, but the answer are not sine functions, they're Bessel functions, very, very strange. Not like this. But look at the sine functions, how nice they are. I have them here. What's the first one? It's like that. It's very similar to the index, to the stock index. The second one goes up and then down. Very similar to the second eigenvalue of my fixed income market. The third one is the one that goes up, down, and then up. It's the convexity. And those three together is what gives me the Fama-French factor model. In musical terms, one is the tonic, the other one is the tonic and octave higher, and the third one is the dominant. So the Fama-French model is the tonic and the dominant. So you do market analysis using three fundamental frequencies, that's Fama-French, which is good for most of the people who are employed like Kalia or Simone. But people like Matthias, they can't work there. You have to work in the noise part of the scale, which is what we developed yesterday. Because yesterday we had no exposure to any of the market directions. We created a pure alpha fund with zero correlation to anything. That's how wonderful it is what we built yesterday, okay? And by the way, if you take me away from the world of sines and cosines, then I can explain every other activity we do which has to do with digitization, because digitization of anything is exactly what we're doing here. I just showed you in passing how you can digitize music. How do you digitize music? You take the sound, you put it against your fundamental frequencies, you keep the first few, and the first few you can forget about the sine function, just keep the amplitude. And that's what goes onto your smartphone. When you have music here, you only store numbers. Which numbers do you store? The numbers that appear as the Fourier series amplitude numbers. You only store amplitude numbers. And then you play them back. You know that? Yes. Yes, that's how it works. But that's for music. How do I do for images? Well, for images, it's almost the same. Yes?
Yeah, but also depends on, for example, compression algorithms, no?
Okay. No, the compression, so the process is always the same. Compression is how many of those frequencies do I keep, right? If I keep all of them, then I don't compress, but I go from infinite information to infinite information. But since people know that the human ear can only hear so much, then I throw away those frequencies. You can't hear them anyway. And that's compression. So if you accept, for example, that the bit rate I'm going to get is 320 hertz, for example, then I keep only those frequencies and the rest I throw away. And that's how I can go from infinite information to finite information. And that's how you digitize music. How do you digitize pictures? Same thing, except sines and cosines are very bad for that, because remember, that was built for one-dimensional musical instruments. If you want to digitize pictures, you go to this one, right there, the third one, the one in the middle. That's the one they use for JPEGs. But it's exactly the same. And so on and so forth. These are called wavelets, by the way. Okay? And this is how the linear world works. So what I want to do now is, actually I have a video for you. I don't know if I'm going to play this video. I almost don't have time. It's a good video though. Because I'm about to talk about how machine learning is used to take what we've built here, which is linear, to the non-linear world, okay? I'm improvising now. No, I'm not going to do that today. This is what I'm going to do, okay? I am going to play the video for you a little bit. I will do the non-linear theory tomorrow, because I will be rushing. I still have to tell you the non-Gaussian world. So today I will finish with the non-Gaussian world, and then I will do the non-linear world tomorrow. I don't know how I will do that, but I will do it. Okay, because I was planning to do something different tomorrow. Yes, I'll come up with something. Okay, so let me play this video a little bit. Will we get another bell in 15 minutes or so? In 5 minutes, okay, then. Oh, at 5. Okay, so we're going to play this video. It's a very good reflection it's a very good introduction to machine learning. This is Leslie Lampert. It's a video that was made of him. I hope it works. Sometimes, now YouTube sometimes doesn't let me use my videos in lectures. I will see. But it's his reflection on programming, computer programming, which is something that I want you to know before we talk about it. Let's see if this works, okay? Can you hear?
My name is Leslie Lamport, and I am a computer scientist, which is something that didn't really exist when I started being a computer scientist, and it took me a while to figure out that I was one. My relationship with computers began as a programmer. It never quite occurred to me that I was doing anything scientific until after I had published enough papers that it finally occurred to me. My education was as a mathematician. It was just natural for me to think about computers as a mathematician. When you write an algorithm, you need to have a proof that it's correct. An algorithm without a proof is a conjecture. It's not a theorem. And if you're proving things, well, that means mathematics. Computer scientists tend to think in terms of programming languages. One of the epiphanies in my career was the realization that I was not writing programs as a computer scientist, I was designing algorithms. I came to realize that if I'm not writing a program, I shouldn't use a programming language. People confuse programming with coding. Coding is to programming what typing is to writing. Writing is something that involves mental effort. You're thinking about what you're going to say. The words have some importance, but in some sense, even they are secondary to the ideas. In the same way, programs are built on ideas. They have to do something. And what they're supposed to do, is like what writing is supposed to convey. If people are trying to learn programming by being taught to code, well, they're being taught writing by being taught how to type. And that doesn't make much sense. The best way I have for teaching about programming, as distinct from coding, is to think about what the program is supposed to do mathematically. There's a very big practical problem with this. The mathematical education in this country is pretty terrible. Most people wind up being afraid of mathematics. This is even senior programmers.
But the most important part of the video for me is his distinction between programming and coding that some people tend to confuse. And he says that programming is mathematics, whereas coding is typing. And that's pretty accurate. So what I want to do when I try to now go beyond these models we've developed here, the simple linear Gaussian models, everything we have done is linear and Gaussian, everything. When we go into the non-Gaussian and the non-linear, then we need to take that into account. And I wanted to use that video as inspiration. So I'm going to I want to start to go into the non-Gaussian world. And in the non-Gaussian world, you're going to see that it's a mess. It's full of misconceptions, misunderstandings, and wrong expressions, wrong formulas. We're going to walk through that so you understand. And I'll be very practical. I want you to understand these things, but I also have to tell you that many of you will have to get a job in the industry, and you have to use these terms and these wrong formulas. And you'll be paid for that, so that's why you do it. But I want you to know that they don't work. Okay? It's an important education that I have to give you. So let me start with an explanation of what the non-Gaussian world is. This is the histogram of a very well-known, doesn't matter what it is, a very well-known index, investment index. And then when you look at the investment index, you can see that, yeah, the center of it maybe looks very Gaussian, but there's these events here that shouldn't happen according to a Gaussian world, and they do happen. So when we talk about non-Gaussian markets, we're really talking about markets that tend to have unexplained behavior, usually on what's called the left tail, the part of the tail that corresponds to losses, not to gains. And that's why people worry about this, because they worry about losses, not so much about incredibly large gains every once in a while, okay? So this is our target. Now, there's many different ways to attack the non-Gaussian world. One of them is by moving windows, exactly the same method that I showed you earlier. When we saw those, we take a 2-year window and we move it and then we get oscillations. Okay. Now, this is a very common way to do it. And we already saw it doesn't work. And the reason it doesn't work is because when you have a window, and if you assume that that window is Gaussian, and then you move it, and you assume the next window is Gaussian, then your whole distribution is Gaussian. You don't do anything non-Gaussian. People think they do, but they don't. You understand what I'm saying? So it doesn't work. The next method, which is oftentimes used, is the exponentially weighted moving averages. And I'm sure you've encountered this, and actually it's a standard for many financial institutions. What an exponentially weighted moving average is, and I suspect you've seen it, is one where you weight your observations in the past with a decreasing exponential factor. So you take today's observation with 100% accuracy and yesterday's with say 0.9 and the day before 0.9 squared and then 0.9 to the power 6. You've seen that. This is called exponentially weighted. If you think about that, that's nonsense also. Because we already saw that things on earth should be like they are in heaven. And the estimators we had for mean and return and volatility and covariance, they are based on heavenly objects, but this has no heavenly object. This is not an estimator for anything. So it is a formula that can be done in Excel that people use, but it had no meaning. You understand what I mean? It has no meaning. It has no mathematical meaning. So it's just an expression, and no one really knows what it means. I understand the intuition behind it, but so this is an example of something that should not be used. Now, ARMA models, those are good. They are well defined. And GARCH models are also good, well defined. Robert Engel got the Nobel Prize in Economics for his development of the GARCH models, but they're very complicated and no one really knows how to use them and no one understands them. So people don't use them in the industry. Okay? So the industry is full of two types of models, the ones that don't work and the ones that would work but people don't understand, so they don't use them. Okay? I want to focus my attention on two, which are used but we can understand. The first one is this. It's the semi-standard deviation. It's very, very heavily used. In fact, if some of you are doing the CFA, which I don't recommend, but if you are, then you probably encounter that because this is part of the CFA standard. Okay? And what this does is as follows. Let me first tell you the logic behind it. So the standard deviation, you remember, we saw it earlier, yes? Okay, so the standard deviation is a number which is obtained by doing an arithmetic calculation every month, which is your mean return minus your actual return, squared, sum over your history, divided by the number of observations, or minus 1, and then the square root of that. And we saw this is the observable. This is the estimator for the standard deviation. And that's where it works because it's the observable of a heavenly object, right? Okay, so many practitioners look at that and say literally, that's a mistake. It's a mistake because if you have a month with very high performance, that month will give rise to a high standard deviation. Standard deviation is a measure of risk, but if you have a good performance, that should not contribute to the risk. That's how the argument goes. You're following me? Okay. Now, as you know, this has no mathematical foundation whatsoever because the big returns already contributed to the mean. And that's why also you consider the big events as part of the calculation for the standard deviation. So what they do is they get rid of the mean altogether and they write a benchmark target return, which I called R star. This is your benchmark target return. And then they calculate the contribution to the semi-standard deviation only looking at the months where you lose money. And I wrote it like that with that plus term there that you have seen when you do option pricing very often, because You have audio now?
Yes, good now, thank you.
The battery ran out. Long lecture, 4 hours. Okay. So as I was saying, if you have to use this at work, then ask what n is supposed to be, because there's no right answer. Okay? And if you're doing an exam where they require, maybe even here they use that, I have no idea. If you have an exam where they use the semi-standard deviation, then find out what that number n is. But I can tell you it doesn't matter what the number is, this quantity is wrong. Okay? It's useless. It's completely useless. I'm going to do a number of useless things now. This is one. But they're used, so you should know what they are. Okay? All right, there's no heaven. All right, good. In fact, if you look at the original paper by Sortino, Sortino is a very famous finance professional who, see, after you destroy in the year 2000, there was a movement to destroy the volatility, by the way. And this is what I told you. Everybody had a PC, so everybody thought it was very clever because everybody could implement calculations on a computer. Everybody knew how to program in, I guess back then it was, Visual Basic, I guess, VBA. And then everybody was a genius. Everybody had a VBA computer. You could program anything. So everybody programmed their own thing, and wow, it was a plethora of things. So if you now, and there was a movement to destroy the mu and destroy the sigma. And in fact, I heard people claim that Markowitz should remove his Nobel Prize. I heard that too. Okay, of course, didn't understand what Markowitz did in 1952. So anyway, after the sigma, the volatility was destroyed, it was replaced by this one, and the result is not the Sharpe ratio, it's the Sortino ratio. Low integers, right? This is good harmony. There was no tritone there, right? No square root of 2. I don't think so. Yes? Okay. I will finish this. We'll take a break, okay? Because this is the last thing I wanted to do. This is actually written in the introduction of the Sortino ratio. It was written that the standard deviation has to be replaced by the standard deviation of negative asset returns, thinking that the semi-standard deviation is the standard deviation of negative asset returns. This is written down in the paper, but it's not true. That's the standard deviation of negative asset returns. I'm telling you. By the way, this has a heavenly version and an earthly version, but it's not what people think they are doing. So what people think they are doing is wrong. What they say they are, it's wrong. It's not it. So that should not happen to us. Okay, your superpower is your mathematics. Mathematics is the ultimate superpower. As I told you, it helps you detect nonsense. It also makes you powerful. So we've done a bit of nonsense detection today. And now I want to do a little bit of a power dynamics, how that is going to help us move forward, okay? So we leave it here, take a 15-minute break, and then when we come back, I'll tell you how to finish the non-Gaussian story, and then we'll continue tomorrow. Okay, so I'm going to now talk about another favorite of a non-Gaussian approach that is used in the investment sector. This was also created around the year 2000. Most of these creations are from the year 2000. And I want to explain to you what this is all about, because they're very, very commonly used. This is a bit more complicated than the other one. The other one is just nonsense. There's nothing there. With moments, there is a mathematical foundation. Unfortunately, it doesn't work, but there is a mathematical foundation to moments. And the thinking goes as follows. You know that a Gaussian distribution is characterized by the first and second moments, right? If you know the first moment, that's the mean. You know the second moment, that's the standard deviation. So then you know the Gaussian distribution. So the thinking was that if you are dealing with distributions which are not normal, if you know the rest of the moments, the third moment, fourth moment, fifth moment, then you can recover the distribution. And this is something which is true. It's something which is true. And in finance, people stick in investments. Sorry, in investments, people typically stick to the third and fourth moment, the skewness and the kurtosis. You may have heard of that. The skewness and kurtosis. Yes, you're familiar with that. Yes. Okay. Just so that I know what I'm. Did you hear that in a good context, a neutral context, or a negative context? Or you don't know? Did you heard it? Okay. Okay. No, the reason I'm asking is one of the most interesting days. I've been lecturing for I don't know how many years, decades, centuries. And perhaps the most interesting day in my teaching career ever was I was teaching a course just like this one many years ago to a bank. People in the bank, there was like 60 people from the bank, from presidency, from this and that. And when I got to this chapter, I explained, as I'm going to explain to you, the skewness and the kurtosis, and then I basically said what you're going to hear me say later, which is that they don't work. Okay? They're good mathematical creations, but I will explain to you why they don't work. And when I said they don't work, then there was almost a mutiny in the, students usually don't create mutiny, but bank employees, if they feel like they want to do a mutiny, they can, and they did. And the reason was that they told me that a consultant from somewhere, London or somewhere, had been there the previous day teaching them a course, which basically told them that this is the only thing they should do, using skewness and kurtosis. I know that was very popular in the year 2000. I think today people don't care about this anymore, but it was part of a fashion to do that. And then I said, what I've been saying all the time, which is it doesn't work. So I just want to make sure that I'm not offending anybody when I say these things don't work. I'll explain to you why it don't work. I'll tell you how often they are used. But these are all good lessons, because once we get away from the area where we see what's going on and we get into the sophisticated methods, like, for example, regression trees or neural networks, we need to know that the phenomena which invalidate these methods do not invalidate methods such as neural networks, where we don't really see what's going on. And that's why these are important things to talk about, to be aware of why they don't work. We will also see what works, but very important, we will see what doesn't work. Okay, so that's why I'm telling you that. And so this is the definition of the skewness. I know there's a lot of variables there, but you're familiar with them, right? Is the third central moment. So R bar is the mean of my distribution. Ri is the return of the specific month, so it's power cube. This weird fraction, n divided by n minus 1, is morally like a 1 over 3. And what this distribution is there is to help me understand whether my distribution is skewed to the right or skewed to the left. So if the skewness is positive, my distribution will be skewed to the right, and if it's positive, it will be skewed to the left. That's the mathematical interpretation of it. And this is 100% correct. It's 100% correct. And with that, we have the kurtosis, which is the third central moment with some weird numbers, which I'll explain. And this is morally the number 3. That's, again, morally 1 over n. And what this does is, again, it explains to us how the distribution is distributed on the tails. If the kurtosis is high, it has lots of very extreme events, and if its kurtosis is low, it has not very many extreme events. And this is the thing, and this is all good. This is all correct. These expressions here are the earthly versions. This is how Microsoft Excel will calculate them, so they are 100% correct. And they're based on a heavenly version, because this is the heavenly definition. And these are estimates of each other. So we have heaven, we have earth, and they converge. They are good, okay? And the result for the kurtosis is this, some zoology telling us, but okay, that's fine. Now, so this is good, and this is sound mathematics, and this is something that is true, but it doesn't work. It doesn't work for the following reason. It's a numerical reason, very important numerical reason, and this is what you need to understand. Once you calculate this inside Excel or inside your computer, if you have an outlier, which is, and just to put some fixed way of thinking about this, if I have an outlier which is 10 times bigger than the rest of the numbers, 10 times, I know 10 is big, maybe even 5, but 10 is a good number, it's easy to do calculations with. Note that if I take 10 to the power 3, then I'm going to have a term which is 1,000 times bigger than the rest. And if here I take an outlier which is 10 times bigger than the rest, I'm going to have a term which is 10,000 times bigger than the rest. So this thing that looks like a sum, a statistically sound sum, and it is. In practice, it's not. In practice, it's the biggest event raised to a big power. Then you take the cubic root or the third root and you're back to a big event. So what you're doing here numerically is recover the biggest event. As long as you have one big outlier, this calculation, the only thing it does is it recovers a big event. So back to my story about what happened to me when I was explaining this to my group of bank employees. It was very gratifying that when I said that this should not be used because it never works, outliers have a way of giving you a number which does not represent what statistically you think it represents. Mathematically, it's good in heaven, but on earth, where you have imperfect data, it doesn't work. Very often it doesn't work, it's misleading. When I said that, to my defense came one of the employees of the bank who had written a paper. He had done the Markovitch theory with the third and fourth moments. And what he had found is that when you do Markovitch theory with the third and fourth moment, the portfolio which is chosen is the one that has the best performance on the worst day. Understand that? Oh, that's something very important. If you understand that, you understand a lot about how the investment sector deals with non-Gaussian events, because that's what they do. Right? If you use this, the worst event, the worst day, is typically the largest outlier. And the largest outlier, depends how big it is compared to the rest, it dominates that sum. So the other days don't really have a chance to compete with the sum, because your data is very often imperfect. So the result that you obtain is that what you think is the skewness and what you think is the kurtosis of the distribution is nothing but the worst day to the power 3, the worst day to the power 4. And you will never notice that if you put it into your optimization machine. The power 3 and the power 4 are very big powers. I know that when you program this in Python or even in Excel, you don't see, but they're very big powers. So you need to have that sense of size for that. And that's where these things don't work. But that's only one of the reasons. This reason is very clear here. If I show you now this is the same time series that I showed you earlier for the mean and the standard deviation, but this is for the kurtosis. And this is, sorry, for the skewness, and this is for the kurtosis. The kurtosis is really a calendar. It just tells you when the big things happened, right? And something big happens and it's there for 2 years. Because once it leaves the sample, then the kurtosis drops again. So kurtosis and skewness, moments in general, lose their mathematical significance when you deal with real data. So they don't work for that reason. Reasons related to the data. Not that mathematically they are not sound, they are, but they don't work, okay? But the best example I have is this, and this happened to me. I'll tell you the situation. As I told you, I was investing in funds, and part of my job was to listen to funds sell me their products, their investment. And there was one who was particularly good at selling and particularly bad at managing. It was a very interesting combination. The fund was a very bad fund, but they had a very good salesperson that knew enough math or had talked to enough mathematicians to put it into terms that were very attractive. So you're going to allow me to act as a very smart salesman now, okay? And I will try to convince you to invest in my fund. I would like you to listen to me, act smart, and trying to see through the nonsense that I'm telling you, okay? Everything we've learned today should find an epic closure if you can detect how I'm trying to mislead you into investing in my fund, okay? So a bit of theatrics now. But you are the ones who are already warned. You need to understand what I'm saying and figure out where I'm misleading you. I'm not going to say anything which is not true. Everything I'll say is true. It will be misleading, but everything will be 100% true. Okay? Ready for that? All right, so I call this the uselessness of skewness. Because I like that title, but in fact, let me just try to sell you a product, okay? And again, this is something that happened to me. The product underneath, I exaggerated it a little bit because then it's very clear, you will see. But this is something that happens. It happens to me, it happened to you, okay? So here I are, okay? I'm here to sell you my fund. I tell you I have a wonderful fund. It's a wonderful fund. And I'm not lying, okay? Everything is correct. It has 7% average monthly return, which annualizes to almost 100% annual return. It's true. Some of you may say, but your fund has very high volatility, has 60% monthly volatility. I say, oh yes. But the reason is that my fund is very volatile. But the reason is that every once in a while we make so much money that drives my standard deviation up. And proof of that is that my skewness is very positive. It's 30% per month. Not only is positive, it's very positive. So the result is, on rare occasions, I make so much money. It is true, I lose money every once in a while, small amounts, or maybe big amounts, but when I make money, I make so much money that my skewness is very positive. That's why I have a very high standard deviation. Of course, behind this, there's numbers. I mean, you're not a machine to see the numbers. You just have numbers. And if I put the numbers in the right colors, you will be tempted to, I can make you think something or other. Okay? Understand where I'm going with that? And furthermore, I'll say, look, my kurtosis is near zero. So I really don't have very big events. So clearly, there can only be one reason why my standard deviation is high, which is I make so much money every once in a while, and that's why. So it's a great fund. Did I do a good job trying to convince you? What can be wrong?
For how long the fund was investing?
I have a whole year, but I could do 2 years, 3 years. I mean, note that I have a whole year here, right? So I could do this for 3 years, exactly a repetition of the same year, so no.
Maybe it happened a big event where the market crashed a bit, but you were not so affected by this?
No. So first of all, this is statements only about my fund. The market is not under consideration here. This is just my fund. So, yes, maybe the market crashed, but so plus you are agreeing with me, right? That's a good thing for my fund. So you should invest in my fund. $100 million, maybe?
One question.
Yes.
We said there are no big events because of the kurtosis, but then we said for the standard deviation, that sometimes we gain a lot of money.
Sometimes I make a lot of money, and that's where the skewness is very high, right? So
But this means that sometimes there are big events.
yeah. You're right. There's big events, not big. I mean, and I do have a positive kurtosis, right? The Gaussian distribution also can give me big events, right? Simon.
Could we know what your return is according to the logarithmic return?
Okay, I'm listening.
I ask you. You said
Oh, it's not in my. I have to get back to you. It's not in my pitch deck. No. But I can guess what it's going to be on my logarithmic return, right? And this is, of course, I'm not going to tell you if I'm trying to sell you, but you can probably guess what it's going to be. What would it be if you use Ito's formula? Ito's formula may not work because this is not Gaussian, but if Ito's formula, you have that right. What would Ito's formula tell me that my average return will be? Real return, I mean, in logarithmic return. Oh, of course, yes, how much? 60%, yeah, so 60% squared is 36, right? Divided by 2 is 18. So I'll probably lose 10% per month. So my guess, using Ito's formula, is that after a year, I'm near bankrupt. Right? Yes? Did you follow that? Ito's formula will tell me that after a year, I'm near bankrupt. My defense would be, oh, Ito's formula does. Come on, Alvaro, you know this is a non-Gaussian portfolio. How dare you apply Ito's formula to a non-Gaussian portfolio? What's your answer? Your answer is, I'm the investor here. I decide whether I use Ito's formula or not. Let me walk you through that. Great return, bad standard deviation, very high volatility, but is compensated with wonderful high positive skew. However, yes.
I was just wondering, high skewness does not imply itself as high standard deviation.
No. Okay. What skewness means, I remind you what skewness was. It's the third central moment, right? So if it's positive, that means that I have big events which are positive. Right? In that third central moment calculation, I have events above the mean and below the mean. When I raise them to the power 3, the ones above the mean win. That means that I make a lot of money more often than I lose a lot of money. That's what I'm trying to tell you. And that's consistent with the high volatility number that I have there. All converging to my argument that you should invest in my fund.
Can you say again, so the skewness,
Yes.
like how do we know that it's large? Like is there...
It's almost, I mean, the standard deviation is 60, the skewness is 30, half of it. I mean, I don't know. I don't know how to tell you. I mean, you ask me too many questions and I'll have to confess, yes, no, sorry, it's a horrible fund. But what I'm trying to develop in you is a lot of skepticism. Because this is skepticism at a level that you can see it. Once you get into calculations using some Python code that you got from some GitHub channel, you don't know. So let's understand that before we start doing crazy things. Yes? This is a very good exercise to develop the intuition as to when numbers mean what people think they mean. Mathematically, everything I told you is true. Simon.
But do we not always need to be skeptic when we see a high standard deviation? It's not
Always be, you're right, always be skeptic. However, I'm telling you, I'm trying to show you my fund, right?
Yeah, but the skewness, you just took the biggest event, and that's like overpowering everything else.
You're right. I mean, at this point now, we're not talking math, so I don't know what to say. I say, oh, my portfolio manager has a wonderful reputation. How dare you? He had, 25 years at Goldman Sachs. He made billions for the firm. Okay. This is my fund. Let's convince ourselves that this horrible fund has wonderful statistics. So let me ask you, what's the biggest event?
From September to
August to September. 300% increase. From 10 cents to 30 cents. 300% is the biggest, 300%. So what's going on in here is something else. It's the asymmetry of simple returns, right? If you drop 50%, you need 100% to recover. So these numbers are always against you. The way simple returns work is that you need twice as high numbers to recover your losses. So I think someone was asking me, what would the numbers be if I use logarithmic returns? Of course, they will be much more revealing because my average logarithmic return is going to be certainly negative, right? The standard deviation will be very similar, but the skewness will not be negative. The skewness of my logarithmic returns will be negative. You see why? Because a 300% event that goes from 0.1 to 0.3 and a 50% event are really lopsided. A 50% event is a drop of a minus logarithm of 2, and the other one is logarithm of 3, which are much closer to each other. It's no longer such a big difference. And then the negative numbers, the logarithms which are negative below, will actually win. I haven't done it, but I'm pretty sure that if I do the statistics of the logarithmic returns, they're going to be very ugly. So we have a compound effect here. The compound effect is the asymmetry of the simple returns, which is misleading all by itself. And then the misunderstanding of what positive skew means. Because big events do not necessarily mean that you make a lot of money, certainly not compared to the loss events, which the simple returns underestimate. So this is important to understand. Yes, Simon. About the kurtosis? No, the kurtosis is engineered so that it's very balanced and very small. I engineered I created. I was a little bored listening to this presentation, I have to tell you. It was many years ago. It's not that I'm very smart, it was just obvious. I teach these things, right? So I stopped listening and said, well, but that's a very interesting example. I've never seen anybody so good at selling something so bad. So I decided to, as he was talking, I created my own example, and then I've been teaching that ever since. You cannot take a course with me on investments and me not mentioning this example. It's a good example. There's a lot to learn from this. And for sure, I do not recommend that you use a package blindly with numbers that would be 100% correct, like every number here is correct, without understanding what's going on behind the scenes. I want you to learn to be very skeptic. Okay, I don't know before you came to my course, you may have thought that investing in the age of AI is these magic formulas to find out what's going up and what's going down. No, that doesn't exist. In fact, if there's a takeaway message from me, it's very, very skeptical. Some things are true, but very few. Most of them are nonsense. And today, we did a walk through planet nonsense.
Did you tell him all this?
No, I have a reputation to maintain. No. I said, thank you very much, very interesting presentation. We'll call you later. No, you don't say anything. No. I don't even say the name of the fund. Although I talk about this, I want all my students to know this example. It's a very important example. is the ultimate exercise in skepticism. Educated skepticism. I told you everything you need to know to understand why these numbers are very troublesome. Did I accomplish my mission? Yes. Did I turn you into educated skeptics today? That was my objective, okay? When I talk about quantitative methods, it's not to say, oh, I can do this, and I take the square root and I get that. No, everybody can do that. We are going to use methods that work, but it's very important to review the methods that don't work and understand why. And by the way, they are around us. And look, I mean, this is nothing, 4 numbers. I don't need a neural network. I mean, I can, right? Okay. So we've done, I'm quite happy with what we have accomplished today. I thought I would have material for another hour, okay? So, but we've understood, what have we understood today? We understood alpha beta separation. We understood how the market works. Some people are paid to track indices. Others are paid to actually be original and give me something different. And then you can put them together. And that's how the investment sector works. We saw that. And we saw that in a Gaussian world, Gaussian linear world, we're in control. The mathematics is fantastic. Very, very powerful. Still, we have to watch out for certain diseases, and we saw some freaks today. We'll just be aware of that. But then we saw that when we moved to the non-Gaussian world, oh my God, it's like we cannot understand almost anything. In fact, I can trick you. Without the use of computers, I can trick you. Not anymore. But I could trick you. I think now we're ready to go no model, Gaussian, non-Gaussian, no model, 100% computation driven, because I think we've developed that educated skepticism. Am I right? And whenever we get a number, we know that the first reaction to the number is we do not trust it. That's the first reaction. And we try different things, and we understand the value of outliers. This is an outlier, 3 times bigger than the rest. Only 3, not 10, only 3. And look what it does, just a single outlier. And there are methods which are great dealing with outliers. But if you use support vector machines, for example, if you use lasso regression, then outliers are a problem. Outliers are the ones that can take you, these are things that you probably know about. Many of you are in data science, so you know those things. So you need to understand if your model is very sensitive to outliers, well, start checking if you have an outlier in your sample, because then maybe that invalidates what you're doing. That, I cannot, there's no rule book for this. You just have to use everything that you know and start from the position of disbelief. Are we good? I'm happy that we saw that, okay? Now, the next thing I have is the nonlinear world, and that's where we are going to start our first incursion into how we use machine learning to do some of this. But we'll do that tomorrow. My plan tomorrow was to look at investment strategies, but so I think I'll start with this, and then I'll move to investment strategies.
You have 15 minutes left.
Sorry?
You have 15 minutes.
I know, but I don't know that I can do anything significant. I was going to start telling you, I have an example. I have 2 examples here. My first example is to understand how we can do a linear, back to the factor model that we did earlier, but this one is nonlinear. It's the relationship between companies, the size of a company, and the volatility of a company. This is a very good, very easy to understand relationship between the size of a company and the volatility of the company. And the linear model does not work. And it's only 2 factors. It's very simple. And that's what I was doing. If I start now, I don't know that I can finish. And that is, so I think I prefer to do it right the next day, and then we go all the way. So I think I need about an hour for this, and then I will devote my time to tell you about investment strategies and how we can use what we know to do with them. Okay? Thank you. All right. I'll see you tomorrow. I was not able to finish my first video, but I think I'll finish today, so it'll be available later tonight, probably. Okay, I'll let you know. And then every day I have technology issues, and I need to fix them by hand, so I cannot have my usual workflow, but it should be okay. Okay, bye-bye.